In investments, growth has to be achieved amidst risk. In fact, growth and risk always go together. However, at times when there can be crises like the ones we're facing, sometimes people actually pull back. But you see, financial objectives have to be achieved regardless of the situation. See, if you're an OFW, you're working in another country because you want to fulfill and achieve your financial dreams. It doesn't stop just because there is a crisis. You will have to educate your children at the right time. You will have to have the right house or residence for your family. You're going to be thinking about your comfortable retirement. Or if you're building funds for business, you'd like to be able to get what you need as of a specific time. And certain things like COVID can be a consideration, but shouldn't be something that will stop you. Perspectives will change with investment horizons. Let me just be very, very clear with this. No matter how much angst, anxiety, or maybe even depression you might have looking at markets today, looking at your investments, looking at the value of the money you put in, think about it. You know that COVID will come to pass. Whether in a year, 2 years, or maybe even 3 years, it will come to pass. But what will happen after that? What's your position after that? See, when you look at this change in perspectives, you look at different investment horizons, the way you're going to be deciding is going to be very, very different. So we will have to say that somehow we have to change that perspective and maybe turn it to what can bring a bit of optimism so that we can position ourselves correctly. What's the expectation? There would be an economic rebound, especially on the next half. There will always be a tale of two halves for 2021. The first half is going to be a bumpy ride, and we're seeing that today. And it's not just the Philippines, it's globally. India just announced, 200,000 infections in one day. We're kind of spooked with 8 to 7,000, maybe even 15. India had 200,000. So the spikes are happening everywhere because of the variants. But you see, when the vaccines are out and the pent-up demand is unleashed, obviously the recovery will be there. And this will happen whether you say third or maybe even the fourth quarter. High liquidity through fiscal monetary stimulus will tend to persist because countries are, coming up with stimulus packages that is like really making liquidity balloon. I mean, there's so much cheap money going around, and there are risks of high inflation. Even a country like the US is facing that. And there's this turbocharged structural trend, sustainable investing and e-commerce. So you're going to see a very different shape of recovery. We're so used to the L, the V, the U. This, as many people will say, now becomes a K. The K recovery is when you see certain industries going up and certain industries lagging behind. And clearly, hospitality, tourism, food businesses, that will lag. However, as mentioned, e-commerce, telcos, the essentials, those are going to be businesses that will start to move up. Manufacturing is beginning to move up. So we're seeing that K-shaped recovery happening in our midst. However, as I say that, yields are going to be low. There will always be this quest to follow higher leads, higher yields that will give you a better interest rate because interest rates are so low because of the liquidity. However, inflation is biting you on the other end. So you're going to be losing money by saving it. If you don't know how to invest, if you don't know how to mobilize your money, you're going to be losing its value while you're saving it. That's the reason why, people are going to be looking at this balancing act between, interest rates and all of these liquidity that's coming out. You will have to be able to maneuver in order to protect the value of your money. So the restart and recovery will take longer as expected. Now we go to the Philippines. After that global view, go to the Philippines, we're going to say yes. Because of this recent spike, that will happen. It will delay us a bit. We would have been a lot better off if it didn't happen, if it, if this spike didn't really happen the way it did, but it's there. So we'll have to contend with it. With these low yields, however, equities and real estate would be the growth opportunities. They would be the opportunities to take on for recovery. But as I say that, companies, and you all know I'm part of the boards of maybe some of the biggest corporations in the Philippines, I would have seen strategies that have turned around from the point of view of last year. The point of view of last year was survival. In survival, the focus was financial positions. The focus was the strength of the balance sheet. People stepped back in terms of capex, in terms of expansions. This year is a totally different story. People have more commitment coming into this year. And even with the spikes, I'm not going to say they're holding back. They're going to be continuing because they know it's a matter of time when the vaccine rollout. Are you going to be waiting for things to get better? Between now and the dust settling, which by far just means maybe the rollout of, like, let's say 25% to 30% of the vaccine within the population. When you have already inoculated 25 to 30%, you know you're getting there. The pace will have to be higher, right? And in that particular point, opening the economy will really be taken with a lot more confidence than we're doing it today. Look at the downside. Let's look at the worst of the worst. This was 2020, right? Property prices, they said, would really plunge. There's a bubble. Distress sales have been very, very limited. I mean, I myself would be in a lookout for a distress sale, for a great deal that I can pounce on. Did I find many? Not much. Not even one that I can jump on. Rental yields have trended lower, minus 5% to minus 15%. But when we say minus 15%, this was concentrated on lower level markets. The upscale market did not suffer that much. The contraction was only minus 5%. So much so that the yields stayed within 4 to 6%. Still much, much better than your time deposit and bond returns. Primary residential sales have already gone up to about 60 to 80% of pre-COVID levels. So the take-up has been good. And this is something that a lot of people are very surprised with. Corporate office rentals are very stable. Very stable. Just yesterday, I sat on a webinar like this talking about valuations regarding office and institutional markets of real estate. And it's quite surprising that BPOs actually grew for 2020, and the growth has been carried on till the first quarter of this year. The big BPO operations in the Philippines are actually expanding. They're actually taking on more space. That is a big surprise for many. We thought, people are going to be working from home. They're not going to go to the offices anymore. You see, we're the Philippines. We're not a first world country. Our internet is problematic. We have very small houses. We're cramped. And if we're now in a place where our children study, where our spouse is also working, it's going to be a very tension-filled atmosphere. So we'd like to go back to offices. And given the chance, if we're given the flag or the conviction of safety, I think we're all going to be doing it. Commercial property leases is where the challenge remains. Obviously, with this kind of closure, with this kind of strict quarantine, we're not going to the malls again. So looking at all that, let us distill this discussion into real estate as an investment. Why is it good at this particular time? Because it gives you a double barrel yield proposition. It can give you the rental, which is a cash flow. On the other hand, it also gives you appreciation, which can come from two sources. One is the natural appreciation, and the other is forced appreciation. Real estate is the only investment instrument where you can spice it up and spruce it up. Get an idea, spend a little money, put certain things there, develop it a little more, then the price of that will have to be better. There is tangibility. There is a question of inventory in real estate. I can buy an insurance policy today. You can buy the same insurance policy tomorrow. I can invest in a mutual fund today. You can invest in the same mutual fund tomorrow. But if I have taken the corner unit of a building today at a certain floor, that particular unit is mine. You cannot buy it unless you get it from me. That kind of positioning, that kind of inventory issue gets you the tangibility of real estate. And that gives you the kind of, valuation that guards against inflation. There's also such a thing as replacement cost. The stone, the cement, the steel, the glass that they're using to construct the buildings today will cost more in the next 3 to 4 years. So they cannot put up the same building or the same project given the same price. So that's the kind of, appreciation that's going to be there. This is something that, as an investment professional, I tell a lot of people, because some people tell me, why will I buy property, Rex? I mean, I can buy Ayala Land, the stock. I'm not stopping you from buying the stock. I'm just saying that sometimes the comparison is actually unfair. You buy the stock yields more, you get your yield, right? You buy real estate, they say you have to wait a little longer. Maybe. But you don't have the kind of leverage you have with your stock than what you can have with your real estate. Because today, you can have a deal with Alveo. They can give you a down payment hurdle of about 10%. Or they can give you an amortization of another, 10 to 20% within a span of so many months. So in X number of years, 2 to 3 years, you've only paid 20% of the property. You own the property, you only pay 20% for it. If it rises in value by 20%, how much did you earn? Not 20%, 100%. That's the power of leverage. Because you own the property before you even paid for it, before you even paid it in full. So your real capital that you've coughed out is not equivalent to the value of the asset. That's why you have a leverage position. This is why, let me tell you, the rich get richer and the poor get poorer. I don't want to contend with the exploitative nature of that statement, but all I can say is this: the rich get richer because they know what to do. I've seen this lesson. Way back 2010, I've been buying units and lots. And as an astute, responsible investor, I bought what I can pay for. Whereas some of my risk-focused friends, the wealthy ones, using the same money I had, actually purchased 5 units. In 2 to 3 years, they sold 2 to 3 units, and they had 2 or a unit for free. That's the way it worked. And it even goes to a point of capital recycling, because after you fully paid for a property, you can borrow against it and use the proceeds to buy another property. That's capital recycling. That's refinancing. But you use refinancing not to get the money to spend, but the money to invest again. This is what astute investors do. It is not taking capital from a base of investments. It's taking capital and rolling it over so that it has the propensity to create more value. That's what real estate can do for you. But on top of that, real estate will be the only investment instrument that's a financial goal as well. All of us want to have the right home for our families. For many of us, our residence is a reward for all the hard years of work. And for our OFW friends, all of those years being in another country, being absent from home, being far from loved ones. In the end, you'd want a reward to have a residence, a home for your family. So in effect, that real estate property can be an investment. You can buy it so that you can have appreciation, you can have a cash flow. But on the other hand, there can be other purposes for it, because at a certain point, it can either be for you, you can use it, or for your children. Let's face it. During our time, we could still invest to get that residence for ourselves. You can just imagine this for your kids. Years from now, how much properties are going to be? Can they buy such? So if you have the capability, why can't you buy a property today that you can take advantage of in terms of being an investment instrument? But when the time comes, that's going to be a legacy for generations. That can be something that your children can start with so that they'll become ahead. They don't have to buy their own property and break their backs paying for amortization because you accorded it for them.